For corporate distributions of property, the corporation acts like it sold the property to the shareholder at fair market value. That means if FMV is higher than the corporation's adjusted basis, the corporation recognizes gain. And that gain increases earnings and profits, which can turn into dividend income to shareholders. On the EA exam, they love testing that the corporation uses FMV, not book value. Here's the trap. In a non-liquidating distribution, the corporation generally cannot recognize a loss when FMV is less than basis. So depreciated property doesn't create a deductible loss just because it's distributed. The shareholder still uses FMV as the distribution amount and as their basis in the property received. Think, gain is recognized, loss is ignored, and FMV drives the shareholder side. The big exception is complete liquidation. If the corporation is winding up and ceasing operations, then losses can be recognized on distributed property. That's why a building with a $600,000 basis and $500,000 FMV can generate a $100,000 loss in a complete liquidation, but not in a normal distribution. Exam tip: if you see complete liquidation, your no-loss rule may flip. Now switch to the shareholder's basis mechanics. A non-dividend distribution reduces stock basis first. Basis can't go below zero. Once basis hits zero, any extra distribution becomes capital gain, usually long-term if the stock was held more than a year. This is a classic EA exam pattern. Reduce basis, then recognize capital gain on the excess. Stock dividends and stock rights are usually tax-free. You're just getting more shares, not pulling value out of the corporation, but they become taxable property distributions in a few gotcha situations. The biggest one is choice. If the shareholder can take cash instead of stock, the stock option is taxable. Also, watch for distributions that shift ownership percentages, like preferred to some and common to others. One more corporate side rule. Stock issuance costs are capitalized, not deducted. Printing, postage, legal fees, accounting fees, underwriting, none of that is a current deduction, even for an IPO. The idea is simple. Selling stock isn't taxable income, so the related costs don't create deductible expenses. Instead, they reduce the proceeds, like selling stock at a discount. Harborview Financial Group is a cash-basis C corporation. It distributes property to a shareholder in a non-liquidating distribution. The property has a fair market value of $120,000 and a basis of $72,000. How much gain or loss does the corporation recognize? Options include zero, a $48,000 gain, a $48,000 loss, or a $72,000 gain. Think about it. The answer is a $48,000 gain. In a non-liquidating distribution of appreciated property, the corporation recognizes gain as if it sold the property for FMV, so it's $120,000 minus $72,000. The tempting wrong answer is zero, but that ignores the treated as a sale at FMV rule for corporate property distributions. Keystone Energy has $260,000 of current and accumulated earnings and profits, and it distributes land to Marco, an 80% shareholder, in a non-liquidating distribution. The land has a fair market value of $200,000 and a basis of $90,000. How much gain or loss does the corporation have, and how much dividend income does Marco report? Think about it. Choice C is correct. Keystone recognizes $110,000 of gain, and Marco reports a $200,000 dividend. The corporation's gain is FMV minus basis, $200,000 minus $90,000. On the shareholder side, the distribution amount is FMV, $200,000, and because E&P is sufficient, it's dividend income. A common trap is calling the dividend only $110,000, confusing corporate gain with shareholder income.